everybody. This is Jim, the Option Professor, and we have a very active day, and I'm sure you got a lot of questions on your mind. I'm going to give you some answers from my viewpoint. Before I get started, I have been doing the options for decades upon decades and doing seminars throughout the country as well as Canada on options. So I've taught thousands and thousands of traders how to trade options. So I'm going to go over what I think is going on right now, where I think the more opportunities are. And of course, there is a rotation going on. So you'd probably like to know where they're rotating into because you certainly probably know where they're rotating out of. And I'll share my opinions on a few of the different markets. I'm going to have to be kind of brief. So at the end, I'm going to give you contact information for me. And if you have any questions that we haven't covered, feel free to let me know. Again, today I'll be just sharing my opinion on things and obviously no advice. So here we go. On the S&P 500 that we're looking at, you can see on a 20-year chart, it is very extended and it could pull back towards 64.27 minimum. That's on the monthly. On the weekly, we've already pulled back to my first level, which was around 68.94, and now we're trying to maybe make a run at the next one, which is 67.80. And then after that, the more solid support would be at the blue, which comes in at around 66.13. So you can see if it wants to roll over here, the RSI is kind of deteriorating, but it's still a little bit uncertain. In other words, I'll show you what I mean. It's still because it's held the purple. So you here in November, held my purple. That came in at around 472 or so. We went down to 65.20. And then here we went down in the month of February earlier. We went down to 67.80. My number was coming in at 67.50 ballpark. Again, a nice test, but it's having a heck of a time getting above 7,000, as you can see. And that has been going on not just recently, but basically since October, because that's a pretty wide range. So whenever it does make a decision to come out of here, I would imagine it's going to be a very substantial decision. So if you start, it's already broken underneath this neighborhood here, which was 69.26 and 69.19. So getting back above that would be very helpful. So that would be where I'd start thinking we're out of the woods. Until then, it could start raining even harder if it deteriorates further, because the next stop down would be purple here, and that comes in at 67.63. So if this thing can't get going tomorrow after that CPI report and starts accelerating to the downside, I can tell you the neighborhood that it might stall at would be 67.63, which is, 100 points down. Now, CPI is expected to be 2.5%, but there could be a surprise there. And why? Because most of CPI is in owner's equivalent rent. And that means the price of housing and the price of shelter. Well, it seems to me that, like I read, it seems like the rents are coming down, and for sure, the real estate prices are coming down. So that number, if it surprises on the downside, would open up two doors, possibly. One is for the Fed to ease quicker than people think right now, and the other might be the stimulus of a lower interest rates combining with the tax refunds. The tax refunds coming out are supposed to be about $100 billion, which is a heck of a lot of stimulus to the economy. Then if you've got the lower interest rates, that could be stimulative. But again, it also is trying to bail out something that's coming apart a bit. So it's not an easy call. It'll be an easier call if we start closing above 7,000. It'll be an easier call if we start closing underneath 67.50. Then it'll be easier call because why? Then you're probably going to go down for a big kahuna correction, which could be as low as 6,200 or so, right? Or if you start breaking out, the FOMO crowd, the people that are short now, everyone is buying, no sellers. That's how you spike up. So I think the resolution of this is going to be quite exciting, and I would be on my toes for either one. We're finding out if you're not on your toes, you can lose a lot of money here. So let me just show you some things that I find concerning. Let's look at the big seven here, Microsoft. I mean, this thing has gone from 560 all the way down to $400. Now, this is like what? The Cadillac of all stocks? Then you turn over to something like Amazon. And you see Amazon is also used to be 260 and now it's at 200. So, these are the companies that I think Apple's hanging in there because they're not spending money like crazy, but they certainly are on the defensive. And if it breaks this level right here, it's going to open up to the downside. You can see right here is very key for it to stop. That's at 260, and it's at 262. So if it starts coming down any further, it'll break too. And then, of course, you've got Meta. Well, Meta used to be $800 a share, and it's at 653. All it did was come up and fill this gap here, and it filled the gap. And once it did that, it was right back into the toilet. So, these are the hyperscalers. This is a majority of the S&P index as far as the weighting. So, not the majority, but, it has a big hunk of it. And then, of course, in addition to that, you have Google, which is hanging in best because they're actually monetizing their investment. But even there, it looks like it could obviously start accelerating to the downside as well. So again, the market is definitely at risk for an acceleration to the downside. And I told people, and I continue, when that VIX gets above 20, it is a warning sign. Now, today it got above 20, but you can see it's back under 20. So if this is all you've got on the VIX and you're coming back down into here again, then the stock market's going to turn right around, in my view. With regards to the percentage of stocks above their 200-day moving average. Very much on the credit, on the, what do you call it, right? On the support here, okay? So this could be, today, could be the worst it gets on these indexes. And if we hold here on the percentage of stocks above 200-day, then we're in good shape. If it breaks here, then it's going to possibly come down here and test what it did in November. That's not going to be good. You notice right here on the percentage of stocks, when we were going down in April, so was this percentage of stocks. And when we have rallied so far since April of last year, the percentage of stocks going up has also gone up. But you notice they've gone sideways a little bit, just like the S&P. So that's why it's very indecisive with a little bit of a bias to the upside, but it keeps leaking to the downside. And if the leak becomes a flood, then that's a problem. So I would keep my eye on this thing here at around 58. And I would keep my eye on that VIX at around 20. And I'd certainly want to keep that S&P. Let's get a level where that might make some sense to keep a good eye. Well, certainly 67.50, but is there any warning before that? Let's take a look at a shorter term graph here. That's already broke. That's kind of broke. And so now you're here. And again, you're a little bit of no man's land. If you can get back above here, which is your 69.25 neighborhood, then I think you're all set. And if they come out with a great CPI number and people really think the rates are going to drop, now let's talk about that because they're on a ledge. They've been on a ledge. This is the 10-year yield. This is the stuff that I find important. So I'm just sharing it with you. This is yields on the 10-year note. Can you see it's got a traffic jam here like we've never seen in the last 20 years at this 413, 417, 420 area, and it's trading underneath it. So it's leaking. Now, if they come out with a report that shows inflation is tanking because the owner's equivalent rent tanks, then you could be looking at these rates coming all the way down to 3%. And that would be very stimulative for housing, in my view. And that's why I've been very constructive with people talking about stocks like this. This is DEH Horton. Can you see? This is an uptrend. This is where it's meeting, and this thing should accelerate to the upside. Why would home builders accelerate to the upside? Because if interest rates go down and mortgage rates go from 6.25 down to 5 or 4.5, that's going to be very stimulative. Okay, so and of course we do need a lot of housing because I think I heard 4 million houses short based on family creations or something along those lines. So this is an area where I've been very constructive. This is where the money's going. This is where the money's going, part of the place. Okay, and so I've got a group of stocks. If you're interested, or of course if you're a subscriber, we can talk about which ones. Again, so there you go there. And I also thought the Home Depot might benefit, and that's not been a terrible idea either. If you look at Home Depot, that could start taking off. It already has done very well because this is the turn where I thought it was a good deal, and then on the pullback, a good deal. And now it looks like it's matriculating to the upside pretty good. They're also running into the staples. So that's why you see things like Walmart, which have been on my report for in the last month or so, that it would be rising. Pull back, buy, and now it's way up here. Other ones in that region, in that shall we say, in that sector. Costco, I don't know how Costco's doing because they had some problems, but not doing bad now. Yeah, that looks like it's taking off. So you see where the money's going? It's going into things that you can't debate about. People have to shop, and Costco and Walmart are where they go. And of course, some of the other products like people like to buy Coca-Cola and all that kind of stuff. So that money's gone over there, but that's getting a little extended, to be honest. So that's why you have to be careful. Some of the stuff on the real estate, might just be starting. Data center stuff. You see, this is coming out of the chute now. I don't know if it's going to keep going or not, but I know it's coming out of a very low area. And so let me just show you a couple of the data center things that seemed to be doing pretty good. Digital Realty was doing okay for a little bit. There you go. So that's a good place. So data center, EQIX. This is where things are happening. You get it? So they're rotating into data center stuff. Some of the data center stuff's already gone. Some of it is, still in the chute, and you might be able to still get something of reasonable value. Um, Other thing is utilities, right? Boring stuff, but it's not boring when you're right. And this stuff is going someplace. So um, these are some of the ones that I've noticed are starting to make. That's not the right symbol. Hang on. PCG. Okay. If you look at the 5-year graph on some of this stuff, there's plenty of room to go. So don't think like just because it went up, it can't go up anymore. There's room to go. And then this one here, some of the energy companies like this, that one just looks like it's taking off. So that is of interest to me because it hasn't really blown off the top yet. And let's just look at a few more. Are you getting the idea? Energy, there you go. Another one that's just beginning to blow out to the upside. And then, of course, this one had a great day today, but this is a no-brainer. They have big contracts with Meta for all their energy. So this thing has been on the defensive. This one in Oklo have got a contract with Meta for energy. And so I don't know if there's any value down here, but these are definitely lagging. The utility ones that I mentioned, they're not lagging at all. With regards to you got the utilities, you got the data center, you got the some of the building stocks, and then of course you've got some retailers. Some retailers. This one was on the alert last year and was very good to us, and is still going good now. Dollar General, and it could have more room to go if it wants to, because you got a gap at 200. You see the gap? So there could be value there on Dollar General still, even though it's had a pretty good run. And that's why I like to look at different time frames because it gives you a bigger perspective. See right here, you wouldn't know that there's a gap at 200, but you would know one thing: this thing looks like it wants to go up. So that's why I find that interesting. That's in the retail. This is one that I had talked about months ago, and this is breaking out. This is Crocs. And so some of these things, on the retail level, because don't forget, they're getting $100 billion in tax refunds. They're going to spend some of it, particularly the middle to lower income people who, when they get some money, they like to spend it because they don't have a lot to spend otherwise, right? So Abercrombie and Fitch was very good to us, and I'm watching it closely because you see, this was last year, tremendous move. This is a correction. I call this a reversion to the mean, and then I'm thinking it might go up and try to fill that gap. So how does it look on the 5-year? You see, it's hanging right on the support. So if this thing's any good, you're in the zone, right? And could it go up and fill the gap? It's not illegal, right? So the bottom line is that's another one that I have on the radar that I think has value. You got to go where you think you might have a better opportunity. You know, these stocks are not kidding around, okay? This is not a joke. Oracle used to be what? Used to be 340. The darn thing is down here. I'm not saying sell it out here. It's a good time to sell, but for God's sake, talk about the Titanic. And then, of course, you're looking at other companies like, I thought this company was doing pretty good, and all of a sudden it fell off a cliff. This is IBM. That's a darn good uptrend, right? So I don't know if this is just a joke, like this was just a joke. And if it gets right back above here, of course, it'd be a fabulous time to buy because then that means this was a false move. Okay. And that's possible. But like I say, on the short run, it certainly doesn't look very good. That's why you have to look at some of the other graphs to see if there's anything you can hold on to. But this thing still could have some downside because, again, a lot of things are very oversold, and this is called reversion to the mean. And it happens to everything at some point. Now, another thing that I brought to people's attentions here is the fact that, in my mind, the Goldman Sachs Commodity Index is breaking out. Why do I think that? Because you see how it's breaking out at 560? Well, on the alert, people who read the entire alert, I mentioned this for a long time. So this thing is not a new thing for us. And this thing popped really big. Now, what happened when it broke up? First of all, what's in this thing? The Goldman Sachs Commodity Index is 50% energy ballpark and 50% broken down by agriculture and metals. Well, the darn energy's popped up pretty good. How do you know that? Because you take a look at something like this. Now, that thing's had a pretty good run. It's not having a good, obviously it's very overbought here, so that's why it's pulling back. But has that been a bad place to be in the last month or so? I don't think so. What about Chevron? So that gives you an idea, that when that commodity index is breaking out and half of it's energy, I thought energy was a pretty good place to do a little bit of business, and it has been. But some of the other stuff, of course, the metals went crazy. And this is some of the gold stocks. They've had a big move. They've reverted back down here. So we'll have to see if this can hold. This 90 neighborhood has been the area of holding and a nice pop back up from 90 to 105. Same thing on your silver, which is all over the place. The silver miners. And of course, I know individual names on this stuff, Ken Ross and Goldfields and, a Newmont and all the rest of them. Uh, Harmony. Anyway, here's your silver. Again, where did it pull back? It pulled right back into the gap, right? And hit the red line. So you went from 90 all the way back up to 105 on this too. So the bottom line is that, these things are still in uptrends, but they certainly are not like they were, a year ago. That's when obviously the home run was available. Now you're getting a lot of back and forth action, which makes a lot of sense because you had a parabolic move. So it's not as easy to do to make out in that kind of thing. On the agriculture side, you do have companies like this that are picking up steam, and this is Archer Daniel Midland, and that could have a future to it. So if you believe that the CRB, the Goldman Sachs index might fill that gap, which I'll show you in a second, this is something that you might keep an eye on. And of course, the fertilizer guys and chemical guys, CF and Mosaic, there could be a future to some of this as well. So you kind of keep an eye on these things if you think you want to diversify into a sector that you might have no exposure to, but you think might have some potential. Because again, I'm thinking that this is very possibly going to fill the gap right here. Do you see this as a gap right there from 2022? I know it's a long time ago, but gaps get filled ultimately, not immediately. And so if they do break 620, I think the odds of that thing happening would be quite high. And of course, if it breaks above 620 and goes up there, well, you figure your energy is probably going to do good. You figure your metals might do good, and you figure your agriculture might do good because that's what's in the darn thing. So keep an eye on it. It could also just tank right back down and break under 560, and the whole thing could go to heck. But it looks to me constructive. It looks to me constructive. And then, of course, we have the drug companies that have been good to us, and people are plowing money into it. This is Merck. Obviously, it made the turn down here in the fourth quarter of last year, and it's been a big money maker on the upside. And then, of course, this is more recent that I put on the alert, which is coming in there pretty good. It just made the turn, like I say, a little bit ago, and it's not quite as strong as the other, but it's going pretty good. And Gilead Sciences, of course, has been breaking out a little bit on the upside. Then it pulled back, but that was a nice breakout. You see, you get a nice trend like this, and you bet that a breakout might happen as long as you buy enough time. That's a pretty good volatility. One that I liked here that just happened today, which which was nice, was this Cognex Corp. You see, it was in a nice formation here. I was hoping for a pop. They don't all work like this, but as long as you're buying options cheap in the $200 range, a couple of these here certainly can get you very, very healthy. And the ones that don't work, you are allowed to cut and run and take a loss on it to some degree and rotate into something where you think has more promise. That's pretty much what trading's all about. Is like Buffett says, don't water your weeds and starve your winners. Direct opposite. So, bottom line is that this was one that we were looking for having a pop, and it just had one today. So anyway, other drug companies that seem like they have a bid to them is AbbVie, and that is kind of starting to make a little bit of a breakout here. And then, of course, you've got Lilly going crazy today. That's a $40 move up, and could be more room to follow if it can get up into this neighborhood. And then CVS, as a in the healthcare business, is also trying to maybe go up and fill that gap. So in the healthcare area, seems to be getting some of the money as well. And of course, we went over utilities, and we went over drugs companies. And again, some of the disruption that they're worried about. This is Cushman and Wakefield. Um, and it gives you an idea that, people are very worried about disruption. They're worried about disruption in real estate and in financial sector. I mean, look at some of these companies have been hit pretty good. This is KKR. I mean, even the brokerage firms are getting hit. The guy who runs Schwab was on Bloomberg trying to explain why we shouldn't get out of his stock. And so, bottom line, 108 down to 94. So even the brokerage firms. But again, look for where they stabilize, because this could be much ado about nothing. Some of these companies are supposed to benefit from AI, not get damaged by them. But again, accounting, legal work, financial, wealth management, they all are, they're all getting hit a little bit here. That's Citigroup coming from 125 to 112 in a very short time. Even the Cadillac of banks, I think, is getting whacked a little bit, gone from 340 down to 300. So, there's concern because what's happening is they go to these companies that charge fees, and maybe they say to these guys, you're using AI, right? Well, if you're using AI, that means you have a lot less people, which means you have a lot more profit. So I want you to cut my fees. Well, that is not what people want to hear when they own stock, is that your revenues are going to be cut. So that is one of the risks that they're talking about, is that there could be fee compression, which would mean revenue compression, which would mean problems for valuations. That's the simple story of what people are fearful about. And that's why they're rotating to where, the companies are a little bit immune from that, like your Staples, Walmart, Costco, that kind of stuff, or other areas as well. So that is a little bit of a rundown. I'll end up with Bitcoin, and then I'm going to explain how I can help you on a weekly basis. Okay, Bitcoin. Again, I've been very good with this because I'm just following the numbers. Okay, first of all, this is what I know about it, and I'm no expert, but here's what I know. After the halving, the history of Bitcoin is it goes up for 12 to 18 months. So the halving happened on April of 2024. April of 2024, where we're trading right around here in the 60,000 range. That's April of 2024. 18 months later, like clockwork, we're at October of what? 2025, 18 months after. And what happened? What happened is we peaked, just like it did in 2012, 2016, 2020. You get it? So what's supposed to happen now is an 80% drop potentially, which would take you down to these highs down here around 25, 30 grand. Is that impossible? Well, you just hit 60 grand. How the heck hard would it be to go down another 30 fast? You just went from 127 down to 60. That's what? 40, 67 grand. I mean, getting another 30 is not off the table. So, I am one who thinks that you have to be concerned about that because not everybody's talking about that. I mean, Tom Lee and those guys were talking about 250,000 Bitcoin by January. Well, we're certainly not there. And they may be right ultimately. But the point is, ultimately, he's not going to help me. So again, if we get above 80, that would be my first sign that maybe this thing is over. But there's a gap there. I'd be concerned it just goes up to 80 or 85, runs into this stuff, fills the gap, and then down we go again. So I wouldn't be totally in there just because it did that. But clearly, if you can get above the 102 area and start closing and getting these lines turning up, then I'll start buying. We're going to take out 127 and we're going to 250. But I'm not going to buy that here because this has no evidence of that happening. And so that's why it's and some of these companies that were the darlings. I mean, this is a company that has been under a lot of pressure, but it's down here. As I was telling people, this 128 area was supposed to be maybe where it would stall out, but it's slipping again. So if I go to the 20-year, I can see that if we go down to 25 grand, you'd probably be picking this up for $50, maybe $70. So be careful out there on this. I think there's still a caution flag out there. Okay, so here's what I'd like to show you while I have a couple of minutes left. I'd like to explain how you could um, join up and get my alerts that come out every Sunday night. Now, when you join up for the alerts, I'm going to give you some examples here. This is 20 ideas that were done in January or December that were on the alerts in November 23rd, November 16th. You see on alert, they come out they come out on a Sunday night. So these alerts were all on the alert in November, December, and they expired last month on January 16th. So here's some examples. And again, they all don't work this way, but there's plenty that have. So here's the deal. On November 23rd, the alert, we put Abercrombie and Fitch on there, and the idea was expiring January 16th, the $80 call and the 50 put. I express things as a strangle. So that means you're buying both at the same time, but you don't have to buy both at the same time. If you just want to buy the call, then you just buy the call if you think it's going up and buy the put later. Obviously, in a market that's collapsing like now, you'd understand why having some put insurance wouldn't kill you, right? Right. So the total of both of these was $275. After November 23rd and before it expired on January 16th, Abercrombie went to 133. That means the intrinsic value of the call, 133 minus 80 is $53. $53 times 100 shares means the 275 at one point had intrinsic value of as much as 5,300. That's kind of what we're trying to do. And here you see Dollar General twice. 213, 261, intrinsic jumped up to 3,500. Why? Because the stock went to what? 155 before it expired. Alcoa 3 times. Okay. $223, $236, $213. Alcoa pops to 67. Intrinsic value goes up to 2,700 to 2,200. So there's 20 of them that occurred just in January. Then last year, and again, I call it an alert because you don't have to buy options on this. You might like to be alert that the stocks might be a good deal to buy here. You're going to be alerted that I believe it's at a very intriguing spot to focus on this stock, like Teradyne at 125 last year, or Google at 290, Applied Material at 210. Be nice to notify alert that maybe you want to watch this thing. Okay, Cloudflare 155. Look at all those Googles at 225. The stock went over 300. And then you've got Seagate at 125. What's that thing at now? DigitalOcean, $37. So you get the idea. There's a lot going on there. Now I got to go and show you how to join up. David's going to put up a link. You click on it. Okay. Then you fill out your information, as you can see, and you either click on quarterly, which gets a $100 discount down to $297, or the yearly. Okay. And then that goes down to $897. Once you hit complete purchase, you're going to get an options course sent to you with your receipt. You're going to get my cell number because it includes coaching, and you're going to get the alerts every Sunday night.